Welcome to your Mortgage Insider Update for January the 12th. It was a busy week last week with President Trump announcing $200 billion purchases of mortgage-backed securities. You might recall back in the 2020 COVID days, the Federal Reserve was buying mortgage-backed securities, and those purchases drove interest rates down significantly. Now they were purchasing somewhere in the neighborhood of $50 to $80 billion per month. So if the Federal Reserve is not buying mortgage-backed securities now, they're actually letting the mortgage-backed securities on their books roll off, and they're purchasing Treasury bonds. So with Fannie Mae and Freddie Mac now going to pick up some of the pace there, and it's not going to be as crazy as COVID as far as interest rate drops, but we did see a 0.25% pullback in overall mortgage rates just in the Thursday evening to Friday morning. No sooner than we got through the Friday week last week, the Federal Reserve was served with subpoenas. The Trump administration serving the Federal Reserve Chairman Jerome Powell with subpoenas for their lengthy remodel at the Federal Reserve building. So there's been a lot of muddiness to start this week off. Overall, interest rates have started off relatively calm, but there's definitely going to be a lot of shoes to drop here. The Federal Reserve Chairman putting out a video statement last night, basically challenging the president against his authority to manipulate the Federal Reserve. So it should get kind of testy in the coming weeks. But overall, the wind in the sails of interest rates coming down surely has really improved the buyers' attitude out there. A lot of pickup in activity over the weekend. A lot of open houses were full, whereas a couple weeks ago they were dead empty through the holidays, go figure. So let's take a look and see where we landed after last week's news. So this week we're going to focus a little bit more on the mortgage-backed security. Now, the mortgage-backed security prices do not work the same as the actual interest rate. So say the 10-year Treasury yield is the interest rate the government's paying on their debt. That's slightly higher this morning, still not significantly changed from last week's news. The mortgage-backed security market, though, was highly impacted. So we're going to focus on the price to the mortgage-backed security, which actually works in the inverse to the interest rate. So we're going to take a look back for the last year of what the price on the mortgage-backed securities done. So as the price has increased, this represents a decrease in the overall interest rate to the consumer. So since September, as back as even in August last year, we saw an improvement in interest rates, which we'll take a look at the 10-year Treasury just for point of reference. But that price has gone up significantly. Late August, we had heard the Federal Reserve was likely going to start to cut interest rates. So before they actually made any moves, we saw the prices increase. So a lot of this has to do with the anticipation of future Federal Reserve cuts. We had prices increase. It subsided a little bit in early September after the Federal Reserve actually made their first cut, and then they made their second cut here at the end of October, which we actually saw a pullback. So the Federal Reserve Chairman, you might recall, came out at that meeting after cutting the second rate cut and said it was not a foregone conclusion that they would continue to cut interest rates. Now, looking back on this now, in early January, we know that interest rates pulled back, the prices dropped. Okay, so interest rates rose, but that vacillated a little bit in late November and into early December when we actually got the last Federal Reserve rate cut at their meeting in mid-December. That came with a lot of unknowns. Would the consumer price index reports or the jobs reports really follow through with some of the job losses we saw back that we started to feel late last year? So we get into this last week on Friday, right before the Bureau of Labor Statistics dropped their jobs report. We had the news from President Trump on Thursday afternoon driving the price higher. So if we look back this last year, we actually have to go farther back to find a time where the prices had gotten to this level. It spiked on Friday, leveled off, starting today off, still above the high water mark of prior times. So let's take a look at how far back we have to go to find mortgages at the same price. For that, we have to go back to the fall of 2024. Now, some might recall the Federal Reserve was talking about something very similar with rate cuts. The last part of August, coming into September, there was a rate cut in 2024, very similar to 2025. The prices grew in anticipation. And then right after they made that rate cut, we saw the prices fall. So interest rates actually pulled back or went higher into the fall of 2024, making for a very volatile, and you can see the chart on this is up and down, up and down. There's lots of volatility until just the most recent history, where we actually see less volatility as it's gotten more and more obvious that the economy has slowed down a bit. Federal Reserve policy should be more conducive to lower interest rates, as the Federal Reserve has lowered their short-term interest rate. They've continued their bond buying, even though they're not buying mortgage bonds specifically, they're buying treasury bonds. That those are driving us into an improved higher price, especially for the bonds, because you have more buyers coming in to buy it, which is driving interest rates down. Now we'll switch over to the 10-year Treasury. Just for point of reference here, the 10-year Treasury bond is the interest rate. So the 4.179% is the actual interest rate if the federal government was issuing these new bonds today that the government pays. That's from just a simple perspective, gives us a good point of reference. And we're going to look at the same 2-year history on the interest rates. So interest rates in the spring of 2024 had hit a peak, came down, like we were just looking at in that other chart, until late August, early September of 2024, got to a low point down in the 3.66% range before moving back up significantly. And we can all recall, if you're tracking interest rates at all, trying to purchase a home or consider when you might want to refinance your home, January 2025 was pretty painful. Interest rates had gone up, and we can see all of 2025, the very volatile year that we had until recently, where interest rates have settled. They've been lower on the 10-year, right? But starting to settle in as the Federal Reserve policies are starting to take hold, where they're going to be purchasing more and more of the shorter term treasuries with the runoff from the Fed's balance sheet. All that to say that interest rates are starting to become a little bit of a better commodity. The more buyers out there buying up the mortgage securities is going to help interest rates. As far as what Fannie Mae is going to do with their investments, they have $200 billion in investments in treasuries. And so what President Trump announced last week was for them to start to unwind their shorter term treasury positions, buying more long-term securities like mortgage-backed securities. It's a 30-year mortgage bond. It doesn't always take 30 years to get your money back as an investor, because some of those loans will get paid off over time. People sell their house. But those longer term duration debts is what's going to help drive interest rates down on the long term, which is what consumers are looking for, giving us back to a point of just under 6% interest rates on a 30-year mortgage. So for the first time, seeing 5.99%, likely to stay sustained at 5.99% and potentially even lower as the months drag on here in early 2026. Make it a great week. Give me a call if you have any questions.